Hello, everyone. Markets have become a little bit nervous. Markets are nervous because the beginning of January hasn't been as aggressively bullish as many expected. We're going to look at a number of things that I think are important. The first one is that the narrative that we hear and read all the time in markets is that central banks are being aggressively hawkish and that has been the policy throughout 2023. However, this graph shows that is absolutely incorrect. The reality is that the Federal Reserve net liquidity in the economy, the Federal Reserve's policy has been fundamentally hugely accommodative. And net liquidity explains a lot of the performance of markets in 2023. Think about it. Look at the graph, courtesy of Bloomberg. If you look at the decline between July and October, it coincides exactly with the decline in net liquidity. Net liquidity meaning reduction of the balance sheet of the central bank, Federal Reserve in this case, and reverse repo injections. So if you look at that, the reality is that in the period in which markets contracted, there was a destruction or a significant reduction in net liquidity. However, net liquidity rose abruptly in the latter part of 2023, and we need to pay attention to the current correction for a very simple reason, is that the market, this is the S&P 500, immediately went up way above that level of net liquidity. Pay attention to net liquidity in 2024, because it is likely to be also a year of three different stages. First half, significant elements of volatility. Second half, in which it will all depend on the reality of inflation, and and in that latter part of the second half, it is important to understand whether there's going to be a real element of rate cuts or whether that is going to be another mirage as it was in 2022. Let's see. But there's one thing that we need to look at that is very important and that is changing the trend in inflation, which is geopolitical risk. Let's look at the next graph. If we look at the next graph, also courtesy of Bloomberg, what we see is that commodity prices are starting to bounce back. 2023 was a year of monetary contraction. We saw rate hikes and reduction in the balance sheet of the Federal Reserve and major central banks. Monetary contraction led to commodity disinflation, which helped the GDP and inflation figures of the developed economies. Yes, however, with the expectations of no more rate hikes and actually some rate cuts and monetary loosening, geopolitical risk comes to the fore and starts to show its ugly face. Freight rates through the roof. The Red Sea and the geopolitical risks in the Middle East, huge problem. Freight rates going through the roof, very challenging environment for costs of goods and services in the near future. Second, commodity prices bouncing back, oil and other energy commodities, as well as some industrial commodities bouncing back due to geopolitical risk, but also due to the monetary loosening process. So we need to pay attention to that because it may derail the disinflationary views of the market. We already saw in the December figure of the euro area how inflation was not in the same trend as it showed in November, and it jumped back up. Very concerning because all of the different segments were also above the target. And what's most important, if there's monetary loosening, it is a likelihood that if we see money supply growth in 2024 aggressively, not just net liquidity as we mentioned, but money supply growth in broad terms, M3 and M2, base and broad money. Let's be very aware of that, because broad money growth could jump aggressively in 2024. Let's see what happens. That may derail the rate cut expectations and maintain inflation at elevated levels. All of these elements are things to ponder. Just take them into account, because we already know the expectations, but we don't know if those will play out. Pay attention to monetary aggregates. If broad money, M3, grows significantly, that's going to be a challenge for inflation. It's going to be also a challenge if base money, M2, grows significantly, but also with it, if loosening leads to a bounce in commodities and costs of goods. Let's look at the next graph, because it also shows something that everybody is talking about these days, which is the January effect on markets. The January effect is called that effect that is created by looking at what happens in the market in January and extrapolating it to what will be throughout the year. If we look at history, when January has been a poor month for markets, usually it's a bad year. However, there are many things that make it different in this era of central bank interference. The most important is that cycles are more aggressive and shorter. The other very important one is that liquidity injections via the repo market, via the window of liquidity, all those different elements of liquidity injections that are less viewed by markets than M2 and M3, and certainly than the balance sheet of the central bank, are very important. Furthermore, the trends, as we saw before, of net liquidity versus markets have not changed significantly. So we may have actually a year in which the economy gets worse and significantly. However, markets behave simply because of a new flood of liquidity in the economy. The base effect of the January impact is not that clear, but we need to pay attention to it. This graph, the courtesy of Deutsche Bank, is interesting. It shows that there has been a historical significant correlation, but remember, central banks are there to push the limits. 2023 was a year of more accommodative policies than one would have imagined. 2023 was also a year of much higher levels of liquidity than one would have expected. It is very likely to be similar in 2024. Let's talk about it all in other videos. Thank you so much for following, and keep defending freedom. Thanks for following. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.